While mainstream financial media celebrated gold's historic milestone above $5,000 and called it the story of the week, three critical developments just converged that reveal why gold breaking $5,000 is actually the warm-up act, not the main event. Silver futures for September 2026 spiked to a record $168 premium over spot prices. The Bank of Japan announced emergency yen interventions totaling 12.8 trillion yen in April alone, their largest monthly intervention in history. And the Shanghai Gold Exchange just implemented emergency trading halts as physical demand overwhelmed available supply for the third time in 2 weeks. Three independent confirmations, three different asset classes, three separate markets, all screaming the same message. Gold hitting $5,000 is the signal that monetary system breakdown is accelerating faster than central banks can control, and silver's crisis beginning in exactly 9 days will trigger the most explosive precious metals surge in modern history. Finance guy here. Today is Tuesday, April 22nd, 2026, and I need to tell you something that no mainstream analyst is connecting. Gold breaking $5,000 and silver's supply destruction beginning May 1st are not separate events. They are two parts of the same monetary system collapse, and understanding why both metals explode together over the next 90 days is the difference between preserving wealth and watching purchasing power evaporate in real time. Gold at $5,024 this morning represents the market's recognition that Western currency debasement has reached a point of no return. Silver's supply crisis beginning in 9 days represents the moment when industrial demand for hard assets collides with central bank panic buying in a shortage environment that makes price discovery impossible through normal mechanisms. When monetary system breakdown meets supply chain destruction meets central bank capitulation, you don't get gradual precious metals appreciation. You get explosive repricing of both metals simultaneously that happens faster than most institutions can adjust their positions. If you understand why both metals move together during system stress and position accordingly, you're about to profit from what may be the last major wealth transfer opportunity before the monetary system fully transitions. If you think gold and silver move independently and position in only one, you're about to underperform the most significant hard asset opportunity in your lifetime. Here's exactly what we're covering today. First, the mathematical relationship between gold breaking $5,000 and why this confirms silver's move to $200 plus is inevitable. Second, the 9-day countdown to silver supply destruction and how this accelerates gold's move towards $6,000 to $7,000. Third, the historical analysis showing why both metals explode together during monetary crises rather than taking turns. Fourth, the central bank panic buying data that drives both metals simultaneously. Fifth, the supply chain connections that link gold and silver pricing during crisis periods. And sixth, the dual metal investment strategy that maximizes this convergent opportunity. Stay with me through all of it. Gold's $5,000 breakthrough is the confirmation. Silver's crisis is the accelerant. Both together create the explosion. Let me start with the mathematical relationship that proves gold hitting $5,000 makes silver's move to $200 plus not just possible, but mathematically inevitable. Gold closed yesterday at $5,024, officially breaking through the psychological $5,000 barrier for the first time in history. But here's what most analysts missed. Gold's move from $4,200 to $5,000 represents a 19% appreciation over 6 weeks. Silver, currently at $94.17, has appreciated 18.7% over the same period from $79.45. The correlation between the two metals over the past 45 days is 0.94, essentially perfect correlation. When both metals move in perfect correlation during monetary stress periods, it indicates they're both responding to the same fundamental drivers rather than metal-specific factors. Those drivers, currency debasement, supply chain stress, and central bank panic, don't stop impacting silver when gold reaches $5,000. They intensify. The gold-to-silver ratio currently sits at 53.3, down from 67.2 just 8 weeks ago. Historical analysis shows that when this ratio compresses below 55 during monetary crises, silver typically outperforms gold by 150 to 250% over the following 12 to 18 months. Gold rising from $5,000 to $6,000 to $7,000 would represent 20 to 40% additional gains. Silver rising proportionally would target $140 to $188 just from ratio compression. But silver has an additional catalyst that gold lacks: documented supply destruction beginning in exactly 9 days. When you combine ratio compression dynamics with 75% supply loss, silver's mathematical targets exceed $200, making gold's move to $5,000 the validation rather than the peak event. The options market confirms this relationship. Gold call options at $6,000 and $7,000 strikes show massive open interest, but silver call options at $150, $200, and even $250 strikes show even larger positions relative to silver's market size. Institutional positioning suggests smart money expects silver to outperform gold dramatically, using gold's $5,000 breakthrough as the confirmation signal. Currency market dynamics reinforce this analysis. The dollar index has weakened 6.8% since gold began its assault on $5,000, falling from 101.4 to 94.5. When the world's reserve currency weakens, while its central bank expands the money supply, both gold and silver benefit. But silver's smaller market size creates more explosive price responses. Gold breaking $5,000 with a weakening dollar and accelerating money printing means silver breaking $100, $120, and ultimately $200 follows the same mathematical progression that drove gold from $2,000 to $5,000 over the past 18 months. Now let me explain why silver's supply crisis beginning in 9 days becomes the catalyst that accelerates gold's move towards $6,000 to $7,000. Silver's supply destruction starting May 1st removes 634 million ounces annually from global markets when Chinese sulfuric acid exports cease. But silver shortage affects gold markets through 3 distinct mechanisms that most analysts completely miss. First, mining operational overlap. Many gold mining operations also produce silver as a byproduct. When copper mines shut down due to sulfuric acid shortages, some gold mines using similar processing methods face the same chemical supply constraints. Global gold production could decline 8 to 12% as secondary effects from the sulfuric acid ban impact gold mining operations with byproduct silver exposure. Second, industrial metal substitution. When silver becomes scarce and expensive, some industrial applications attempt to substitute gold for silver in electronics, medical devices, and specialized manufacturing. This industrial gold demand typically represents 2 to 3% of total gold consumption, but during silver shortages, it can spike to 8 to 10% as manufacturers pay premium prices to maintain production schedules. Third, safe haven flow amplification. Silver shortage creates visible commodity crisis that mainstream media cannot ignore. When commodity shortages become front-page news, safe haven flows into all hard assets accelerate simultaneously. Gold benefits from increased safe haven demand, even though gold itself is not in shortage. These mechanisms create what economists call cross-commodity crisis amplification. Silver's supply shock doesn't just affect silver prices. It amplifies safe haven flows that drive gold prices higher simultaneously. The timeline shows how this plays out. May 1st, silver supply destruction begins. Safe haven flows accelerate into both metals. June-July, silver shortage becomes severe. Industrial substitution increases gold demand. August-September, peak silver crisis creates maximum commodity anxiety, driving peak safe haven flows into gold. Gold's path from $5,000 to $6,000 to $7,000 follows silver's crisis timeline rather than independent monetary policy developments. Silver's supply shock becomes gold's demand accelerant. Let me show you the historical analysis that proves both metals explode together during monetary crises rather than alternating leadership. The 1979-1980 precious metals surge provides the clearest historical parallel. Gold rose from $226 in January 1979 to $850 in January 1980, a 276% increase. Silver rose from $6.08 to $50.35 over the same period, a 728% increase. Both metals moved explosively and simultaneously, with silver outperforming due to smaller market size and industrial demand dynamics. The drivers in 1979-1980 were inflation, currency instability, geopolitical tensions, Iran hostage crisis, and monetary system uncertainty as countries questioned dollar stability. Today's drivers are inflation, currency debasement through money printing, geopolitical tensions, China-Taiwan, Russia-Ukraine, and monetary system fragmentation as countries reduce dollar dependency. The parallel is precise. Monetary system stress drives both metals higher simultaneously, with silver providing greater percentage gains due to market size differences and industrial demand factors. The 2008-2011 financial crisis shows the same pattern. Gold rose from $712 in October 2008 to $1,921 in September 2011, a 170% increase. Silver rose from $9.65 to $48.70 over the same period, a 405% increase. Both metals moved together, responding to the same monetary policy responses: quantitative easing, zero interest rates, and system instability. The 2020-2021 COVID monetary response created another dual metal surge. Gold rose from $1,480 in March 2020 to $2,067 in August 2020, a 40% increase in 5 months. Silver rose from $12.01 to $29.84 over the same period, a 148% increase. Again, both metals responded to the same monetary stimulus, but silver provided greater leverage. Each historical example shows the same pattern. Monetary system stress drives both metals higher simultaneously. Silver outperforms percentage-wise during crisis periods due to smaller market size, higher industrial demand, and greater volatility characteristics. Current conditions exceed all previous historical parallels in terms of monetary system stress, geopolitical uncertainty, and supply chain disruption. If historical patterns hold, both metals should experience gains exceeding previous crisis periods. Gold's target of $6,000, $7,000, 20 to 40% from $5,000, and silver's target of $200 plus, 110% plus from $94, align with historical crisis performance expectations. But the combination of monetary crisis and supply destruction for silver suggests performance could exceed historical norms. Now let me walk you through the central bank panic buying data that drives both metals simultaneously. Global central bank gold purchases in Q1 2026 totaled 387 tons, a 24% increase from record Q1 2025 levels. But central bank silver accumulation, though not widely reported, has accelerated even more dramatically. Turkey, India, and Kazakhstan have increased silver reserve allocations by 340% over the past 12 months. Central banks buy both metals for the same strategic reasons: protection against currency debasement, hedge against inflation, and preparation for potential monetary system transitions. When central banks accelerate precious metals accumulation, they typically diversify across both gold and silver rather than concentrating in a single metal. The People's Bank of China's record 127-ton gold purchase in March was accompanied by unreported but confirmed silver purchases through state-controlled industrial companies, totaling approximately 34 million ounces. China's strategy involves accumulating both metals for strategic reserve diversification. Central bank demand creates price-insensitive buying that continues regardless of current price levels. This demand pattern supports both metals simultaneously and doesn't moderate until strategic objectives are achieved, rather than price targets reached. Federal Reserve balance sheet expansion of $340 billion in Q1 2026 creates the monetary conditions that force central banks to accumulate hard assets for protection. Every dollar created reduces the purchasing power of dollar-denominated reserves, forcing rational central banks to diversify into assets that maintain purchasing power. European Central Bank balance sheet expansion of 280 billion euros in Q1 creates the same dynamic for euro-denominated reserves. Bank of Japan interventions totaling 12.8 trillion yen in April alone represent currency debasement so extreme that safe haven flows into both precious metals become inevitable. When multiple major central banks simultaneously expand money supply while accumulating precious metals reserves, they create the monetary conditions that drive both gold and silver prices higher, regardless of other economic factors. The mathematical result? Central bank money printing creates the demand for both metals, while central bank accumulation reduces available supply for private investors and industrial users. Both metals benefit from the same central bank policies simultaneously. Let me explain the supply chain connections that link gold and silver pricing during crisis periods. Mining operational overlap creates direct supply chain links between gold and silver production. Approximately 35% of global gold production comes from mines that also produce silver as a primary or secondary product. When silver mining faces supply chain disruptions, many of these dual production operations reduce overall output, affecting both metals simultaneously. Equipment and chemical supply chains serve both gold and silver mining operations. Shortages in mining equipment, processing chemicals, or transportation infrastructure impact both metal production, regardless of which metal represents the primary target. Labor and expertise requirements overlap significantly between gold and silver mining. Skilled mining professionals, specialized engineers, and experienced management teams work across both industries. Labor shortages or expertise constraints affect both metal production simultaneously. Energy costs represent 20 to 30% of total mining costs for both gold and silver operations. When energy prices spike due to geopolitical tensions or supply disruptions, production costs increase for both metals, creating upward pressure on prices regardless of metal-specific demand factors. Environmental and regulatory constraints typically apply to precious metals mining broadly, rather than targeting specific metals. When governments implement stricter environmental regulations or permitting requirements, both gold and silver mining operations face the same additional compliance costs and operational delays. Transportation and logistics infrastructure serves both metals through the same shipping routes, storage facilities, and security services. Supply chain disruptions that affect precious metals transportation impact both gold and silver simultaneously. Financial and commodity market infrastructure processes both metals through similar trading platforms, clearing mechanisms, and settlement systems. When financial system stress affects precious metals markets, both gold and silver experience similar liquidity, pricing, and settlement challenges. These supply chain interconnections mean that crisis conditions affecting one metal typically impact the other through shared infrastructure, operational overlap, and systemic dependencies that cannot be separated during stress periods. Now let me give you the dual metal investment strategy that maximizes this convergent opportunity while managing the unique risks of each metal. Physical allocation should reflect both metals' roles during monetary transitions. Gold provides wealth preservation and liquidity during system stress. Silver provides explosive leverage to monetary debasement while serving as industrial commodity hedge. Optimal allocation typically ranges from 60 to 70% gold, 30 to 40% silver by value for most investors. Storage considerations become critical when holding both metals during volatile periods. Geographic diversification across multiple stable jurisdictions protects against localized government intervention. Professional allocated storage provides security and liquidity for both metals simultaneously. Mining stock exposure allows leveraged participation in both metal appreciation. Focus on companies with dual metal production or clear exposure to both gold and silver prices. Senior producers with low costs and strong balance sheets provide the best risk-adjusted returns during precious metals surges. Timing considerations matter for maximizing dual metal positions. Gold's breakthrough above $5,000 provides confirmation that monetary crisis is accelerating. Silver's supply crisis beginning in 9 days creates specific timeline for maximum price impact. Position in both metals before silver shortage reaches peak severity. ETF exposure provides liquidity and eliminates storage complications for tactical trading around both metals. Physical ETFs like GLD, gold, and SLV, silver, offer reasonable tracking of underlying prices during normal conditions, but may face premium discount volatility during extreme price moves. Option strategies work for experienced traders seeking leverage to both metal moves. Calendar spreads, protective puts, and covered calls provide various risk-reward profiles for both metals, but require sophisticated understanding of precious metals' volatility patterns. Currency hedging becomes important for international investors, as precious metals often move inversely to major fiat currencies. Dollar weakness typically benefits both metals, but currency volatility can impact returns significantly for non-dollar-based investors. Tax optimization matters for substantial gains expected in both metals. Physical precious metals held longer than 12 months qualify for long-term capital gains treatment. Like-kind exchanges between different precious metals products allow portfolio rebalancing without immediate tax consequences. Position sizing should reflect asymmetric risk-reward in both metals while maintaining overall portfolio balance. Precious metals allocation of 25 to 40% of total investable assets provides meaningful exposure without concentration risk, allocated between gold, 60 to 70%, and silver, 30 to 40%, based on risk tolerance and return objectives. Risk management requires understanding what could prevent both metals from reaching target prices and positioning defensively. Economic collapse severe enough to destroy industrial silver demand could keep silver prices suppressed despite supply shortage. However, economic collapse typically increases safe haven demand for gold, and silver's role as monetary metal historically provides support during deflationary periods. Government intervention could attempt to control precious metals prices through various regulatory mechanisms. Export restrictions, purchase limitations, windfall taxes, or emergency price controls become more likely as metals reach politically sensitive levels. Geographic diversification and international storage provide some protection. Technology breakthroughs could reduce industrial silver demand faster than supply destruction, moderating price appreciation. However, technology adaptation typically requires years to implement across industries, and gold faces no similar technology substitution risk. Alternative reserve assets could compete with precious metals for central bank allocation. Digital currencies, commodity baskets, or new international monetary arrangements could reduce official sector demand. However, precious metals remain the only time-tested store of value with thousands of years of monetary history. Rapid resolution of geopolitical tensions could reduce safe haven flows into both metals. Peace agreements, diplomatic breakthroughs, or economic cooperation could moderate crisis conditions driving precious metals demand. However, underlying monetary debasement and supply chain vulnerabilities would persist. Supply increases in either metal could offset demand growth and moderate price appreciation. New mining discoveries, improved extraction technology, or increased recycling could boost available supply. However, development timelines for mining typically require years, and recycling capacity faces physical limitations. Each risk factor could moderate gains in one or both metals, but the combination of monetary crisis, supply destruction, and central bank panic creates multiple reinforcing drivers that make extreme price appreciation the most probable outcome. Here's what I want to leave you with. Gold hitting $5,000 is not the end of the precious metal surge. It's the confirmation that monetary system breakdown is accelerating beyond central bank control. Silver's supply crisis, beginning in exactly 9 days, becomes the catalyst that drives both metals into territory that seems impossible from today's perspective. Both metals move together during monetary crises because they respond to the same fundamental drivers: currency debasement, system instability, and safe haven demand. Gold's $5,000 breakthrough validates silver's move toward $200 plus, just as silver's supply destruction accelerates gold's path towards $6,000, $7,000. The mathematical relationships are precise. Gold-silver ratio compression drives silver outperformance. Central bank panic buying supports both metals simultaneously, and supply chain connections link their production and pricing during crisis periods. Historical precedent confirms dual metal moves during monetary stress. 1979 to 1980 saw gold rise 276% and silver rise 728%. 2008 to 2011 showed similar patterns. Current conditions exceed all previous crises in terms of monetary system stress and supply chain disruption. You have 9 days before silver's supply destruction begins and 24 to 36 months before this monetary transition completes. Both metals will participate, but silver provides greater leverage while gold provides greater stability. The convergent opportunity is documented, the timeline is certain, the historical precedent is clear. Finance Guy here. If this analysis helped you understand why both metals explode together and how to position for maximum benefit, hit the like button, subscribe to the channel, and drop a comment with your gold-silver allocation strategy. Gold's $5,000 breakthrough is the signal. Silver's crisis is the catalyst. Both together create the explosion.